Right, hello everyone. So, you're welcome to come to the front if you want. The last person asked to come to the front left, so please do come to the front. I know it's noisy out there. We're going to do it interactively. There are not many people in the audience, so keep your questions for us. So, this session is all about you're a founder and you're looking for investment. And you've got several problems to solve. You need to find investors. You need to persuade them to invest in your business. You need to show your valuation. And importantly, you need to find the right investors. So in the next 45 minutes, some with us and some with your questions, we're going to go through the journey for you as a founder to work out who are the right investors to talk to, what is the right pitch to give to them. You'll get secrets from our investors. And so now, without further ado, we have three investors who are going to briefly introduce themselves that represent each stage of your journey. But just before I hand over to them, I think the startup journey goes something like this. A couple of friends, a couple of people get together as founders and start a business. No one's going to invest in your business based on just a PowerPoint and waving your hands. You have to build something. So our data at Seedlegals shows that founders put a median of £26,000 of their own money into the business to get something built, a prototype. Then you may raise £50,000 from friends and family. Then you may raise £150,000 from angel investors, SEIS. Then you may do a seed round raising £500,000 from early stage funds. And then you may do a Series A raising a few £1 million. And that is broadly your journey. And you might think after 3 funding rounds, your business is profitable and you don't need to raise again. Or you're ready for an exit and everyone makes a fine exit. So here on our panel represent the 3 angel, seed, broadly, and Series A phases. So now, Jenny, let me introduce over to you.
Good morning, everybody. My name is Jenny Ervine. I'm the CEO and founder of Raise Ventures. What we do at Raise Ventures is work with early stage startup founders, and ideally what we're looking for is that really early stage that Anthony referred to. Industry founders that understand the real problem that they want to solve. They've worked in the industry, they've come across the problem, and they're like, I really want to fix this. I really want to make the world a better place. They get together, as you said, with founders, they come up with this idea, and they need to go and build something. Quite often, as I mentioned, we have industry founders that understand the problem, but also we have tech founders that come to us and they're looking to commercialize their idea and take it to market. So we work with them in that commercializing their tech product, building the best foundations that they have, not just in their business plan, but looking at that investment journey. Because quite often, if you've worked in industry or if you worked in technology, you won't have been privy to the investment journey and understand what cap tables are or term sheets are. So we work throughout the program with our early stage founders to give them the best chance in raising that seed early stage investment. And we do a lot of work then later on in those investor networks, building those connections, building those relationships, and getting those early stage funding rounds under the belts, and using the likes of platforms like Seedlegals to help facilitate that process.
So when a founder is approaching you, it's a really early stage, you don't have revenue. So what are the things you're looking for? Is it mostly, it's about the team, the idea, the personality, is the pitch deck?
Yes, absolutely. At that early stage, whether it be friends or family or even angels later on, they're looking at a real problem that they're solving in a big market that's going to have scalability. They're looking at a team that can deliver on that, and not just industry knowledge, but resilience and leadership to be able to build a team around them and deliver on that. And then a good tech solution, and it doesn't always need to be deep tech. It can be good tech that's got mover advantage, or it understands the market.
All right. So now you've got your first smallish round, you've built a team, you're getting a product to market, and now you're ready to go to the next level in school. So, hello, Claudine.
Good morning, everyone. I'm Claudine Owens, and I work with Clarendon Fund Managers, and I have 2 positions. I'm an investment manager for CoFund and also the coordinator for Northern Ireland's HBAN. So as an investment manager with CoFund, we invest on a matched fund basis. So if a company can find private investment, whether it be from business angels or private institutions, we have the ability to match fund that on a up to 50% basis. And my position with HBAN, I organise Dragon Den style events, pitching events, 4 to 5 times a year, where 6 companies will pitch to all the HBAN members. And at the minute we have about 115 HBAN members that are exited CEOs, investors, high net worth individuals that are trying to build up their portfolio. So there's a strong network there. And we've invested, our angels have invested about 9 million in the last 3 years over 59 rounds. So it's a busy business.
And what stage business would you think would be perfect to come to you?
Really, we look at all stages. We look at early traction and scaling businesses for the HBAN members to give them a bit of variety. But their sweet spot really is post-product and post-revenues. And wanting, obviously, as Jenny said, a business that wants to scale. So.
Okay. Now, one of the key problems I see with founders is they go to the wrong type of investor and they get this very nice message at the end of the presentation going, love what you're doing, you guys are awesome, come back later. And the come back later is when you've gone to too later stage investor too early. And the later stage investors, it's going to be less about the team, perhaps, and more about the revenue and the growth. And that's my segue to Ronnie. So over to you.
Thank you, Jonathan. So my name's Ronnie Geddis. A bit of background, I started life out as a coder, so I was a developer. Too many years ago to mention. But really spent most of my time in sales, so sales and marketing director for a software business. Sold it in 2015, and since then I've probably been an angel investor, so I'm probably at all 3 stages. So I think I've 10 companies in my own personal portfolio at the minute. Some I did on my own as an early stage investor. I'm a member of HBAN. I haven't done any through HBAN yet, but I'm a member of HBAN. And I also represent a company called Power Equity in Northern Ireland. I'm their local chairman. And Power are similar to Clarendon. They're made up of 250 plus business angels, private investors, and Power pulls that together into one collective fund. So it's people like myself who can want to get involved in maybe some bigger opportunities rather than just a small organization. We can get together with Power and pull that together. Power themselves, so I do some small ones. What I'm looking for when I'm doing small ones is product, good ideas. You're having a little bit of a punt on the team. It's certainly about personality and whether you can believe that. When you get later on to somebody like Power, they're looking for revenue. They don't do startups. Another thing about Power is they don't do B2C. They're only interested in business to business, so they have some key criteria. You must have revenue. You must have at least 300,000 a year revenue, which is quite modest, but what they're really saying is you've got through that stage of building a product. You've got proof by somebody has actually paid for it. You've got customers, they're using it, and they want to give you money to scale, to take you to the next stage, maybe pre-Series A. But I think we mentioned when we were talking before, Jonathan, I think at that stage, the idea has got you in front of them. It's not necessarily that important anymore. You know, they've obviously talking to you because they like the space that you're in and they understand that space. It's about the team and their belief that you can execute your plan. So if you're presenting numbers at that stage, you've got to really believe in those numbers. You've got to understand them. You've got to understand how you're going to do them. You know, people talk about we're going to be 10 million in X number of years. You know, I really like to know how you're going to make your first million. I'm not really interested in that because it's in the future. How are you going to make your first sale? How are you going to make your next sale? How are you going to make your first million? That's when, do we believe that you can execute on the plan that you've presented to us? That's the biggest thing I think that people are looking for. The idea might be great, but can you deliver what you've promised?
Okay, so the key to cracking the code, if you're a founder looking for investment, is to understand what each stage investor is looking for. And then I think you're telling them a story that's going to tap into what their stage is and what their thesis is, which we'll get to in a moment. So to kind of recap, you've got no revenue. don't go talk to Ronnie yet, at least with his big hat, because he's all about revenue. You've got no product yet, maybe don't go to Claudine quite yet. You're going to go talk to Jenny. I'm paraphrasing slightly. But really, it's what an investor is doing. And if you get in their mind, you're going to increase your investability. And in their mind, earlier stage investors are going to take, as Ronnie said, a small punt, a few tens of thousands of pounds, maybe 50, maybe more, on the team and the idea. You haven't built anything yet, so it's only about belief. But when someone's writing a check for millions of pounds, it's all about the validation. You have been able to build a team. You have been able to get it to market. You do have paying customers. So let's talk very quickly then about valuations. So one of the key problems you're going to have is when you go to an investor, actually there are two problems. One, you need to propose a valuation or ask them. We'll get to that in a moment, the valuation. And two, you may need to justify the valuation. So if you say, my valuation is £2 million, you've got no revenue, you've got no users yet, where did the £2 million come from? If you ask your accountant, they'll say it's zero, you're losing money. So my take is that the valuation game goes something like this, and then I'll put it to my colleagues and see if they agree or not. So initially, two founders get together, put some of your own money into it, you've got a prototype. 300 or 500,000 pound valuation. You've built something usable, 800,000. You've got it live, £1 million. You've got revenue, £2 million. And north of £2 million, you might take a 10x annual revenue. So let me put the hypothesis to our team. Maybe it's old data. What would you say that you're seeing?
I think it's a very valid question, and it all depends on the market that the product and the team are in. You know, there's lots of enthusiasm and investment valuation curves aiming towards the big tech companies in cyber, insurtech, fintech, and probably climate change. So because there's lots of demand out there in the market from the big corporates looking for the tech solutions that they can't build quick enough, then they would be willing to potentially partner up with these startups to deliver a product, and therefore the startup then hooks their first customer, and it's not an SME, it's a big corporate, and then all of a sudden one customer can create a very substantial valuation. So I think market factors play into it. Of the companies that come through our accelerator, we would say once they come through our accelerator and are ready to go for investment, we would put a 1 million valuation on our companies at least, because we believe that they have good industry expertise, they have a product, they are selling. They might only have 5 beta customers, and those customers may be paying a discounted rate, but they have proven traction, and they are all in good markets that have substantial valuations. And the valuations that we're seeing in the last, and maybe the guys can reflect on this, in the last 6 months of the year, because of pent-up demand and lots of cash in the market, valuations not just here in Northern Ireland but in London are definitely going upwards. So there's the founder has to put forward the valuation that they believe is true, and we encourage them to put forward their best foot, and there's always a negotiation across the table.
As my co-founder, ex-VC, said, everything's a negotiation. All right. Claudine.
Well, I think that's what I was going to say. I agree with the criteria you've both mentioned there, but I'd always say to the companies that it is a negotiation. You know, it's very much what the investors will agree it's worth as well. So I always tell them to be open to that. Put a valuation on that they can back up, with the figures or what they've done or the money that's already been invested, whether it be friends and family or anything, any other funds at that stage, and where they think they've got to. But really be open to negotiation, because it's better to have, a big chunk of what's the right way of saying it? It's better to have a small piece of than nothing at all. You know what I'm trying to say? Yeah. So I think just be prepared for negotiation, because the business angels lots of them have been in those markets and in those situations, and they're very aware of what they're willing to pay too. So.
And so, Ronnie, the valuations, the multiples, if you can give away your secret sauce to this small audience, no one will tell anyone else.
No secret sauce, but I think this is probably the most difficult of everything, is the valuations. It can be very emotive. I mean, I remember when we were going through it ourselves, our old CEO said, we think we're Manchester United, where all the investors think we're Accrington Stanley. You know, so you always have an overinflated ego or valuation of what you're doing because you're living it every day. It's a difficult one. And in some ways, sometimes some revenue is more devaluing because, you know, we've seen it before. If you have no revenue, well, you can't base your valuation on what you're doing. You're really only basing it on the potential in the future. So sometimes you can be worth more with no revenue. The problem is once you start getting revenue, everybody homes in on that, and then it's not enough, so everybody uses the revenue that you've got, and they're looking at your traction. So it's a very difficult one. I tend to find when I'm looking at something for myself, I'm looking for value. So I want, what percentage am I getting for the money I'm putting in, for the risk, et cetera, et cetera. So I think private individuals are always looking for more value, and we want to drive the value down a little bit, because if we're getting in really early stage and we're giving you some expertise, we want a piece of the action because we know we're going to dilute. We're going to help you get to the next stage, and then our shares are going to be diluted and diluted and diluted. So when you're an early stage angel investor, I think you're always going to, well, you've seen it in Dragon's Den, which is quite a good, Peter Jones is always saying about your valuation's crazy, so we're always looking for value. I tend to find that the higher you go up the food chain to a bigger investment, the less they seem to be worried about percentages, because they want to make sure there's enough incentive for the shareholders. You know, I know some funds won't take any more than 20%. You know, that's the maximum because they don't want to de-incentivize people or de-incentivize people. So, yeah, it's a difficult one. You do look at the revenue and you want to look at that multiple. As Jenny said as well, depends on the sector you're in. If you're in a sector where you're solving a real problem, like if you found a cure for cancer, for example, you're not making any revenue yet, people are going to invest in it. So if you're in certain sectors like med tech, sometimes people are taking a punt. You might be the one that's going to solve this problem, and we'll get in early and take a piece of the action. But usually we're looking at revenue, we're looking at traction, believability in that. But yeah, valuation, it's, you know, there's no secret sauce.
All right, no secret sauce. Okay, so here's one really interesting top tip, which is there are two good times, I think, to raise money, and one not good time. And the not good time is counterintuitive, because you might be thinking it's the good time. So the first good time to raise investment is kind of at idea stage, because investors are betting. They're making a bet. And if you've got a nice idea, you present it beautifully, there's a great pitch deck, you haven't built it yet, they may buy into the idea, not at a huge valuation, unless it's presented beautifully. But there's no proof point to say that you can build it or not. They're buying into the idea. The next point is just post-launch. And most people will look to raise money to get them to launch. And we've all read TechCrunch, you know, Clubhouse goes insane or whatever. But actually, raising money just post-launch, in my view, is the bad time to raise. Because almost always you launch and there are like 20 people that download your app. And it's a bit of a damp squib. And that's actually because it's the beginning of the journey. You've launched early, you haven't got product market fit yet, you haven't spent money on marketing yet, and this is where you're starting to build customers. But if you go to an investor and they go, how many users do you have? You go, 18. They're going to go, love what you're doing, come back later. So the third time that you may raise is when, exactly per Ronnie's proposition, you've got customers, you've got traction, your month-on-month growth curve is up. And that's a great time. So can you think about your fundraising so that you raise enough to carry you through launch to get to beyond, or enough to get you well before launch, so you're going to do another fundraise beforehand, and again, targeting the appropriate folks. So switching track very quickly, finding investors is hard. And we always read we should get warm intros to investors. Cold calls, no one answers the emails. Let's put this to the test. So ways of reaching you. Do people need warm intros? Can they do cold calls? Do they go to the website?
I think it depends on the stage. So early on, we were talking about friends and family and angel investors. I think it's working your network, and obviously warm introductions play a place whereby people understand the product that you're building, and if you got that introduction, they can explain it in your behalf. They're nearly being brand ambassadors, and those warm introductions can come from your network of friends, family, colleagues. They can come from even the service providers like the lawyers and the accountants, and using their networks to be your brand ambassadors and selling your story on your behalf. But I also add to that, over the pandemic, obviously doors have opened up. LinkedIn's been a fantastic tool, and you didn't have to phone the receptionist to get through to the investor at the other end of the phone. So that has facilitated. So cold calls have a place, but you have to remember that the person on the other side of the phone is time poor, and you have to be very sharp on what you're delivering and what your ask is. And it's maybe not, I want investment, it's maybe, can we have another coffee? You're building relationships in cold calling, and even in warm introductions, you're building relationships. The first question shouldn't be, have you got any money that you can invest in my company?
All right, Claudine, when I say cold call, I meant cold email as well. But yeah.
We will speak to anybody, so in any shape or form, whether it be a phone call, an email, just happy to have an initial conversation, and sometimes that's all it can be because it's just the wrong stage at the wrong time, but we will follow those through and ask the company just to keep in contact, and we can direct them then to Raise or to Techstart or to wherever it does, if it doesn't suit HBAN or it doesn't suit co-fund at that time. So just happy to meet anybody, always,
Yeah,
in any shape or form.
Yeah, that would be my experience too. I think at the minute, everybody's looking for deal flow. I get that all the time, deal flow. So since I've been doing what I'm doing, people just contact me on LinkedIn, and I nearly always will talk to them. And I've had references from other people in the industry. Basically everything we get I pass on, and if it's not for par, for example, yesterday I passed one on to a London firm that I'm connected with as well, and they've said the same, just keep them coming, Ronnie. It was just, they're looking at lots. They're looking at lots, so the more the merrier.
Okay, so don't believe that you have to have a warm intro, although if you find someone who can do one, fantastic. But now, what is the perfect email to send? It's not send £2 million. So Ronnie, what would catch your eye in an email subject line and body?
No, nothing specific, to be honest. I mean, I say people, you contact me on LinkedIn, they just, hello, it might be a recommendation for somebody told me to contact you, it might be. Or it's just, this is who I am, this is what we do. It would be great to have a Zoom call. And I think one of the things that the pandemic has done, it's made us all a lot easier. Yeah, we'll just jump on a Zoom call because we don't have to jump in a car and go and meet anybody. And I think that's made life a lot easier, to be honest. We've all become more accustomed just to doing conference calls. I would do Zoom calls. I'm retired, but I'm doing Zoom calls every week. And it's just, even if it's half an hour, maybe sometimes that half hour turns into an hour. And that's when I go, well, that must have been interesting because I stayed on the phone for an hour. So that's the first telltale that you like something.
Okay, so if you're talking to an investor for more than 30 minutes, you're in. So really, I think the learning point is the first message you send the investor is not to get their investment, it's to get the second meeting and just enough to pique their interest to respond.
This might sound a bit, there's lots of money out there, and I know it's difficult to get, but there is lots of money out there. I know 3 funds that in less than a year from standing start have raised 60 million each to invest. They're wanting deal flow. Now, that doesn't mean that they're ready just to give money to everybody, but there's a lot of money out there. So they are looking for opportunities if the right ones come along.
So, Claudine, what's the perfect pitch line to you?
A bit like Ronnie, there's I just say hello and ask for a meeting, a Zoom, a coffee, whatever. There's no real... I probably don't. I mean, if there's a pitch deck attached, I'll have a quick flick through it. But I'll not go into it intensely because I like people to kind of pitch it to me when I meet them. And I think you get more out of a conversation and meeting somebody and then pitching to you rather than trying to flick through and make the most of it yourself. So, yeah, just email me.
Okay, so now we come to the next question, which we've seen your investors are friendly, are probably going to take your call if you pitch it nicely, show a problem you're solving, and can you connect with them. question is, where do you find investors? And when you've got a company, a VC, they've got a website, and there might be directories where you can find them. With angel investors, they're everywhere. You know, anyone who can invest 20,000 or
They're at HBAN.
At HBAN as well, right. So, but they don't have a website. So where do you go looking for investors? And so thoughts?
Well, very much like HBAN, we've also built up a community of angel investors, and it's just through our network of startups and through, we run similar events whereby it gives opportunity for startups in Northern Ireland to come along and pitch to angel investors alongside what HBAN do. So instead of just having 4 chances a year, they might have 8 chances a year to be pitching to potential angel investors. And those are kind of community-led, whereby it's more sit back, watch the pitching event and build those conversations, because we are slightly earlier stage. So we're building those conversations. They're delivering the relationships, and then the conversations kind of take 2 or 3 steps before maybe they think about investing. So I think it's more for startups of working your network, working the network that's out there, building those relations. There's syndicates, there's formal syndicates and informal syndicates, and once you find maybe one angel investor, then they might also have a network then that they'd be willing to work along with. So it's just get out there and keep talking to people, and it's a bit like sales. You have to talk to 100 before you find one customer. You have to talk to 100 investors maybe before you get one deal. So
let's talk about how long it'll take to close a round, because you need money tomorrow. Should you be raising today, or should you have started 6 months ago? So what would you say the time from someone first calling you to an investment completing?
It always takes longer than what you expect it to, and that's just unfortunately.
Is that like a month, 3 months, 6 months?
No, it would be probably closer to the 6 months, I would say. It really, I suppose, depends how sophisticated and how far you are along in legals, and have that side of things ready too. I mean, that's always good, and how informed your data room is. If you've all that kind of ready to go, it can be a lot quicker and a lot smoother. But we would find if a company pitches, within the next couple of weeks, we'll arrange maybe some post-pitch meetings. Then there'll be a bit more due diligence done by the investors, and then it's kind of into legals. The quickest I think I've seen that done is probably about three months. But we've seen them drag out a lot longer than that. So, but the more prepared you are at the outset, the quicker it can be for everybody.
Okay, and Ronnie, your side?
Yeah, I would say probably 4 months, 4 to 6 months. I suppose it depends on the level of investment. If you're a small company, not looking for, you won't have a lot of due diligence to be done. There's not a lot to look into. The more money you're looking for and the more due diligence there is, then that takes longer. But it's when do you go looking for money as well. I was always told, go looking for money when you don't need it. It's the first time that we went looking for money, we didn't need it to run the business, but we had plans of where we wanted to go. I think it's always harder if you're desperate and your runway's running out. It's really hard because then stress levels there. I think for me, go looking for money when you don't need it. It's always better looking at it than looking for it.
So this, unfortunately, is the truism that the time that investors call you is precisely the time you don't need their money. Your business is profitable, you've done your last round, things are going well. Investors are calling you. They want to give you money. It's like, dude, I called you last year. You didn't want to give me money. Now you want to? So that's a problem. Okay, so the next thing I want to talk about briefly is matching your pitch to the investor. So you've already seen the personality of a few investors. And I was in the audience on a panel, and on the panel were 2 investors. There was Hussein Kanji from Hoxton Ventures and Harry Briggs from BGF. And the question is, do you make investment decisions? How do you make an investment decision on valuation or which company you want to invest in? And Hussein Kanji explained how he takes the business plan, runs it through Excel himself, does an analysis of future revenue potential and CAC and customer acquisition cost and lifetime value. And after all the numbers, he comes up with a valuation and decides if he's in or not. And Harry Briggs goes, well, if I like the founders and I like the segment, I'm in. So the next key to cracking the code with your investor, in my view, is to do your DD on the investor and find out from their website, from their LinkedIn, which things are the drivers for them? Are they very mission focused? Are they changing the world? Is it all about the numbers? So if you can connect with the investor, both on your outreach to them, saying, hey, I see that you've invested in company X, and we also do vegan food or whatever it might be, that might be the hook to get you in. And if you think they're a numbers person, don't spend time, as much time, trying to wow them on the team or something like that, or the mission, or pictures of whales or something. They just want to see the graph that goes up. So, you know, does that match what you're seeing?
I think you've articulated it pretty well there. I think you do need to do your homework on the investment company. You know, there's one I'm involved with in London, and they only do B2C. It's all they're interested in. They only like sustainability and things that are changing the world. That's what they've decided that they want to do. Power don't do B2C. They only do B2B. They like med tech. You know, so there are certain funds out there who like specialist things. They like certain things. So do your homework on that. Personally, you know, I like to stick to what I know. I'm a software guy, so I like software companies. I understand them, or I think I understand them. Somebody starts talking to me about biotech. I've done a couple of punts in that because I've trusted somebody else's opinion. I don't understand it. I don't think I can add value there. So a lot of angel investors tend to stick to what they know because they feel they can add value.
So if you're a SaaS software business, your perfect pickup line for Ronnie, you've already sussed that out. Okay, so now what I want to talk about is level of ambition. So this is quite fascinating. At Seedlegals, when I went fundraising, I had angel investors going, love what you're doing. And then I found larger funds going, love what you're doing, but will it be a unicorn? And I discovered that they said, you're going to have a great business, it's revenue, founders will have a nice exit, but is it going to be a unicorn? And so there's another secret, which is the way different investors look for a return on investment. So if you're an angel investor putting in 50K or 20K or 5K, if you make a 5x return on your investment, pay no capital gains thanks to SEIS or EIS, write off 50% or 30% of your investment, it's a great deal given that the bank is going to give you 0% interest right now. But if you're a fund, the way funds often work is they'll raise a big chunk of money, invest in 10 companies, do follow-on rounds, but they're looking for each investment to return the fund, as it's called. So they know on a fund basis of 10 investments, maybe 5 will lose money, a couple will make 2 or 3 times, and one of them will make 50 times, and that returns the fund. So the fund manager is often looking for each investment to be the 50x. So what you now need to do is show the right level of ambition. If it's too unambitious, you'll find angel investors may be in. They're happy, but you'll find it harder to go to funds. So then, having known this, you now dial it up to 11, and you show that your revenue in year 5 will be £400 million, and that's totally unbelievable. So let me start with what's the sort of level of ambition that you like to see? And I think one of the interesting things is, in Belfast, if you're showing that you're focused on deliveries for Belfast, well, that's going to be a smallish market. Show that your deliveries for London, that's a bigger market. Deliveries for Europe is a bigger one. So investors will be looking to the scale to see if they're a fit at their stage. Thoughts?
No, I definitely think the founders have to have ambition, even at the early stage, to attract the attention of the angel investor, because they're like, this could be a journey. And it is about, the angel investor doesn't want to just always add money, they want to add expertise. And if they can add that value and be part of that journey, it's something for them to talk about. We talk sometimes about around the golf course or around the dinner table. Oh, I supported this company and it did really well. And that's kind of their passion, because they want to give back and they want to be part of that journey as well as investing in their money. So I think be ambitious, look for opportunities and how you can scale, not that one customer, but that 1,000th customer or that 10,000 customer. Where are they going to come from? What are those markets? Are they Europe? Are they America? Are they Asia? They might not be on your roadmap right now for the first 2-3 years of funding, but they need to be there in terms of your vision and what the opportunity is. And this is hard work for the founders. So they want to have a good exit, so they want to see the opportunity, and they need to be getting up every morning and delivering on this opportunity. So I think they have to be ambitious to see that there's going to be a good outcome, maybe in 8 or 10 years' time.
Okay, so for me, one of the key purposes of business plan, which will show 3 or 5 year, P&L, is everyone knows they're completely made up numbers. You're probably miles off, but I think it's a key that investors will pick up as the level of ambition. And if it shows that it's growing 8x year on year, this is mathematically not going to work. You're going to be bigger than Facebook in a few years. If it's 1.3x year on year and sort of then drops further, that's a bad sign. It means you're maxing out a local market and you're not thinking big enough. So, Claudine, what would you look at from those business plan graphs? What would you look at in a sort of multiple year on year? And is there
I
a
suppose
formula?
we don't necessarily look at multiples directly. As long, I've always tell the companies that are pitching, as long as their projections, they can back them up and they're realistic. They're not over ambitious that they don't make sense. But if they can say, well, it went from that to that because we moved into this other market or we've introduced new products, as long as they can back them up, because that's what the investors will question them on. Every time there's a pitch, it'll be, why did you move from there to there? And if it's something that looks just unfathomable or unrealistic, then that just it loses credibility.
And Ronnie, I'm hoping you're going to simplify it greatly and go, your business plan should be 3x, 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 2x, 2x.
It's the next big issue after valuation. Because I've seen it from different angles. It's nice to be ambitious, reach for the stars, you might get to the moon. But they have to be believable. They have to be, it's nice to know that you've got a target market of whatever that happens to be, but you may not be the team that's going to do that. That might be your exit. Your exit might be to get it to a stage where then somebody else takes over, and that's their upside, is that big American market or whatever it happens to be. But I come at it from a point of view of being the sales director, having to deliver the numbers that we promised to the investors. So my job was on the line, on my shares, because I had to sign a service level agreement. And if I went after year 1, I lost 80% of shares. If I went after year 2, et cetera, et cetera. So you're also putting a plan that you might have to sign up to, warranties, covenants, step-in rights. So the bigger you go up the ladder, the more investment that you take, the more risk. So you have to deliver that plan. And I don't think people think enough about what happens if I don't. I've seen shareholder owners lose everything because they've just been let go because they haven't met their numbers, and then they don't have anything. So yeah, have ambition, but you have to hit your numbers. Particularly if you're taking £1 million, £2 million, you must hit your numbers.
And I think that's key. And we're sort of about to wrap up or go to you for questions, which is that business plan, those numbers. You've made them up because you don't have any evidence that, made them up in the nicest way. It's a forward projection. But depending on your investor, they will put you on the hook for meeting those numbers. And that's the challenge, with coming up with crazy numbers that will justify a huge valuation. You often see that in crowd rounds because there isn't the feedback of a £50 investor doesn't have preference shares, anti-dilution, a board seat. They can't enforce those rights easily. So if you are too aggressive with the business plan, firstly, an astute investor will not believe it and will be put off. If you come up with too high a valuation and you can't sustain the valuation post-launch, because then the reality kicks in. Year 1, you said £2 million of sales. You've had no sales. There's a big reset. You won't get investment at the same level. So that's a serious problem. So I'll then leave you, before I go to any Q&A, on a phrase from my co-founder, which is, triple, 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 double, double equals unicorn. And it's actually quite easy. If you start and you get to £1 million a year revenue, and you triple your revenue for 3 years, that's 27 times. Double, double, that's 100 times. That's £100 million a year revenue and a unicorn valuation. So you don't need to go giants. You think about it in stepwise pieces. Of course, it's an untrivial problem. You still have to get to your first £1 million. But you might also keep that in mind as the phases for growing your company. So I hope that was useful for cracking the code. Now, do we have any questions that we can put to the panel? Steve, back there. So the question is, for the video, is describe the one that got away. You were going to invest in Facebook, you just passed a note.
And we've been running our Raise investment events now for 4 or 5 years, and I do remember early on it was more just a platform for companies to come along and pitch and invest and meet investors, and our Raise Accelerator wasn't running at that time, and Cloudsmith was a company that pitched at our Raise events early on back in the days, and most recently they've gone on to raise a huge funding round most recently, so that'll be one that I would say we would have loved to have had on our programme.
And do you recall why you said no?
I guess at the time, to be fair, it's very technical led and it's very data focused and cloud led, and it's not something myself as an angel investor understood. But now looking at it and understanding more about the technical sector and reading about it, then I can see the value in what they're doing.
That would be the one I would mention as well. They pitched in front of one of our first HBAN events, and none of the angels got it. They just didn't understand the way it was presented enough, you know. And at that point, we probably weren't maybe pitch preparing the companies enough, but nobody understood it.
None for me. But I haven't been doing this long enough, so I suppose the only one would be my own company, because when the first time I took the money and running, if I'd have stayed in, it would have been different. I think it was the largest exit of any software company ever in Northern Ireland, so I missed out the second time.
So I think what's interesting is, you know, the ones that were both passed on were clearly a pitch that was way too technical, very detailed. Clearly people were really onto something, but they either weren't great at pitching, or at least pitching to their audience, or finding the right investors. But nonetheless, they did persevere, found the right investors, then did deliver the vision, and now, of course, enter the legend of the ones we passed on. So the other point that was raised back there, just to wrap up, was, you know, sometimes it's equity investment and sometimes you should get grant funding. So here's my very quick take, which is grant funding is attractive because you don't give away equity, but you may spend a long time applying and waiting, and I like to run things with military precision. What's the main thing that will get you to success? And if it is growing your team, your audience, not waiting for the off chance that a grant will come through, focus on what will get you there sooner, but mileage might vary. So thoughts on grants versus equity, and then we'll wrap up.
Yeah, I would say particularly in the medtech sector, and Innovate UK is very supportive of R&D and grant funding, and assure that, as you say, that can co-fund alongside maybe your angel investment round or your seed funding, and as you say, make sure that the time spent on that is worthwhile, and you understand there's very good agencies out there in terms of grant writing that know how to help with that grant procedure and make sure you've got the best chance of success, because it does take a lot of time, but raising investment takes time. So, you know, as a founder, you need to realise, how's your day going to look? Are you going to still be able to look after your customers? Are you still going to be able to manage your investment round? And how can you manage both of that and make sure that that time is well spent to make the best success of your investment round?
Nothing probably more to add than what Jenny's just
I think grants are hugely important. Every company I've been involved in have really benefited from all the grants, R&D, tax credits, innovation grants. Probably wouldn't exist, a lot of them, without I&I support and grants, so I think it's crucial.
All right, so we'll just each give our details. I'm Anthony from Seedlegals. When you do find your investment, head over to Seedlegals to do all the legals for your deal. You'll find me on LinkedIn, and just otherwise anthony@seedlegals.com.
Yeah, my name is Jenny Ervine of Raise Ventures, jenny@raise-ventures.com.
Claudine from Clarendon Fund Managers, but the easiest email address would be claudine@hban.org.
Just find me on LinkedIn, Ronnie Geddis.
And everyone likes your cold call incomes. So, all right, thank you very much, everyone.